Sit down, you can.
Okay,
Great.
Chair.
great.
We have Paul on as of yet?
Yeah.
Bauer.
Are you from St. Louis?
No. Okay. Sure.
Okay.
Yeah.
Yeah. Do that.
Don't worry about your own.
Um,
Don't do it.
Yeah. Oh, yeah, yeah.
All right.
There you go.
I'm just surprised you have now been.
That's why I'm behind.
Yep, I'm sorry.
Thank you.
Litigation.
So.
Fine.
Prestigious firm. Sure. One of the
Even after ambulances.
It's very stacked.
It's previously been with Sidley Austin in DC. City and they've recorded Dow Bennett would be large clients.
Most capture.
Yeah, that's.
All right,
It's incredible.
are we ready? Madam? We can't do anything before you're ready. All righty, I'd like to call the meeting to order. It is 9:32, depending on the clock. I think I told you the story one time when I was with my son for 20 years. No two clocks on that campus out there ever had the same time. So it was just lucky if you were early or late. I mean, you never knew exactly what time you were on. All righty, very good. First item of business is the
Do we roll call?
roll call. You gonna do that, Becky? Matt is not here yet. Roll call from last month's meeting.
Heather Dunn,
Yes.
Paul Hample,
Here.
Lieutenant Colonel Lord,
Here.
Sharif Mansur.
Yep.
Jody Patterson.
Here.
Anthony Watkowitz,
Here.
Milton Wilkins,
I am here.
Vicky Frederick. Matt Livesey, attending virtually momentarily.
Is that it?
Is there-
Okay, let's move on to the approval of the minutes of the August meeting. And Maggie, should we approve the executive session minutes in executive session? Or no?
You can go ahead and approve them when you get into executive session.
When we get to executive session?
Yes.
All right, fine. So we'll just approval of the official minutes of the open meeting from last month.
Motion Hample. Second.
Moved and seconded, Capital and Mansuri. Very good. All in favor?
Aye.
That seems to be the least contentious thing amongst you. All right, next item of business are the approval of the, excuse me, I gotta get this up on my screen. I was talking to Sherry prior to the meeting. Screen up. Next item of business are approval of the request for benefits.
Mr. Chair, I would make a motion that we approve those benefits with the exception of Tony Weaver's. We need to investigate whether he is eligible to receive his benefits.
I understand Maggie briefed me right before the meeting. Any other questions or comments about the civilian benefits? And, you made a motion, can I have a second? Jody seconded, I heard.
Thank you.
All those in favor?
Aye.
All right, next item is approval of the police benefits. And there are none. Next item, civilian death benefits. Motion to approve.
So moved.
Okay, Pepe and Jody, all in favor?
Aye.
And police requests? No. Thankfully. So that brings us to you. We try to be expeditious and make the best use of our time with you. So take it away.
Maybe can I just introduce you all real quick? So, again, William Blair here today. So William Blair, as a reminder, been a partner with the county for, I think, almost 15 years
Yeah.
now, quite a bit of time. And so, They are our sole now international small cap manager. So as a reminder, for a long time, we had two international small cap managers. One was Mondrian, kept focused on the value side, and William Blair on the growth side. As we made some other changes in our portfolio within the past year, we hired Silchester, does add a little bit of small cap in their portfolio, so we thought it made sense to move Mondrian's proceeds into Silchester. So we've asked William Blair to come in today to, again, talk about their process, talk about their team, who they are, talk about, the county's performance over the last 15 years, particularly over the recent years, as well as outlook looking forward. So probably 25, 30 minutes.
Refresh my memory, when was the last time we spoke with you, either in person or via Zoom?
We spoke virtually 2 years ago.
Fine. Very good, thank you.
Thank you. So good morning. I'll just, sort of expand upon what Finney said. Thank you for having us. Thank you for the 15-year relationship. We truly appreciate it. A 15-year relationship is a pretty special thing. So thank you. My name is Julie Rancourt. I'm the relationship manager at William Blair, working with both yourselves, with Finney, and serving as a liaison to our portfolio management team. I'm joined by my colleague, DJ Nyman, who is one of the lead portfolio managers on the international small cap strategy, also working with Simon Fennell, who's based in our London office. DJ and I are based in Chicago. So we're very happy to be here with you today. I'll spend just 30 seconds going through the firm, introducing the team, but we want to save the bulk of the time for the portfolio, performance, expectations, outlook. Also, we invite you to ask questions throughout. We're happy to save time at the end, but if you have a burning question as we're talking, please ask. We can hit those as we go along. So William Blair, just to refresh your memory, headquartered in Chicago. We are a private partnership. Lots of ways to manage money, lots of successful ways for us. We feel this is the best way. It allows us to take a long-term view, both into the markets, into our teams, resourcing our teams. More importantly, and why we think it benefits our client, is it allows us to attract and retain the best talent. It's a wonderful structure for folks that are learning their careers, learning the industry, that want to take a long-term approach, but also a great spot for folks to spend their careers, to grow. It's a very flat structure. Research analysts and portfolio managers are very collaborative within their organization. It's not a hierarchy or a top-down approach, very much a bottom-up, grassroots, flat type of structure. The firm at the end of the second quarter was just about 72 billion. High level spread between, we have a US growth and equity team, our international equity team, which is about 40 billion. The small cap strategy that we manage on behalf of St. Louis County is just under 2 billion. So a meaningful part of that team and our firm. Clients span US clients, international clients, retail, institutional, wealth. So it's a very diverse base of clients within both the firm and strategy. Just quickly, I know you have copies of the book. Looking at page 10, just to introduce you and orient you to the team and how the team works together. The left side are the portfolio managers responsible for buy-sell decisions within the strategy. DJ is middle, just slightly under the middle of that page. He also works on our emerging market small cap strategy. So really seeing the entire spectrum of that small cap structure. I'm joined by Simon Fennell, who's up at the top part of the page. We have global research analysts in the middle of the page. As you see them top to bottom, example, consumer, the analysts at the top would be covering more large cap names. And then as you go down the list, we'll look at consumer as an example. Daria Fomina would cover the large cap in that sector. And then down through Mike Paxton would cover the small cap. So they're broken out by cap structure there.
I'm going to digress for just a second.
Sure.
I do want to ask you questions. I'll forget if I don't ask it. It happens with age as well. Is there an Edward Blair the fourth still affiliated with your firm? Or
Edward,
no?
I don't know.
He
There-
will be in his 70s.
Not still affiliated would be my,
Do you remember the name?
I do. The Mr. Blair, going back to, there's been a number of Blairs at the firm
Not
throughout the
surprising.
years. And again, founded in 1935, and then there was a place for a number of them, Edward Blair, Bowen Blair. But they're a little bit of,
They're removed now.
it's now, we've got a little over 2,000 people at the firm now. So it once was a small organization where you could bump into people in the hallway, not so much anymore.
And we're classmates in business school. I was just wondering if he was still around.
That's great. And then just quickly on the right side there, we have our strategy research folks that think about kind of macro issues, economists, our systematic research, which help with some of the plumbing and the quant work and things like that on the strategy, and some portfolio specialists and sustainability folks helping to support the overall business of the team. Any questions on that? I want to make sure we dive into DJ, make best use of his time. We're happy to go through a quick highlight of the philosophy that you've retained us for, if that's helpful, just to orient you. I think it'll help make all the comments from here on out a little more pertinent when you.
Yes, I think it would be helpful,
Okay.
particularly since we have three relatively
Okay.
new board members.
Okay,
It would be helpful, I think.
perfect.
I was just gonna ask you, you talked about, you mentioned assets, both of the firm and strategy. Can you talk to maybe just broadly over the last 5 years, the direction those have gone, either up, down?
Sure.
flat?
Sure. So over the past 5 years, when you think of what those 5 years have encompassed, we've gone through a pandemic, we've gone through a Ukraine-Russian war, various, China and everything that happens in China. As a firm, William Blair has been very fortunate to be in a net positive cash flow position from our clients, from clients like yourselves. And why I highlight that is it's a little bit different from the rest of the industry. So if you go back 5 years, back to 2018, 2019, headed into COVID, our assets were more in the $55 billion range. We're not in the business of just gathering assets. I think it's more of a proof statement that clients want a fundamental bottom-up quality growth strategy. So it's that quality factor that I think really appeals to our clients. But it's a very different position than some of our competitors have been in, where there's been net cash flows out and they've had to trim staff, they've had to trim research resources. Those inflows, we love the inflows, but it does allow us to resource our teams. It allows us to hire additional research analysts, portfolio managers, put money into technology. So perfect example of that, as you look at this chart on page 10, earlier this year, we hired 2 new portfolio managers, Ian Smith and Paul Burchinell. We weren't necessarily looking to hire 2 new portfolio managers. They're covering the emerging market sector for us. They were folks that we had developed a good relationship with. We thought they could help make our team better. And so by being a private partnership, by being in those, cash flow positive type situations, we had the resources to hire talent when we see it. So it gets right at that attraction and retention of talent that we feel benefits our clients.
What about small cap strategy specifically?
Small cap specifically it's been in year to date, it's been a slight net outflow position of about 300 million, largely due to rebalancing. We've also had some rebalances into the strategy. So the strategy is closed by and large. So you'll see kind of a natural attrition of assets, close to new business, but we always like to retain capacity for existing clients.
But a net cash outflow of 300 million?
Year to date through Friday.
Okay.
And you're not opening it back up?
We look at capacity, we base capacity on days to trade, et cetera. We have no plans to open it. We do maintain it for existing clients. We do maintain that for existing clients, but not, no plans to open it up and broadly market it. We like to make sure we retain the excess return potential for our clients. Okay. Any questions on that?
Okay. Good morning, everybody. Like Julie said, my name is DJ Nyman. I've been at William Blair for over 20 years. I'm a partner of the firm. I've been on our global equity team since 2009. I'm a co-portfolio manager and a co-director of research. I've been an analyst as well, so I've held every role there is to hold within the investment organization. One thing that we didn't say up front, but William Blair was founded in 1935. The origins are really in financing and investing in small cap companies, they're growth companies in the Midwest. It was industrials companies originally, but that's expanded to all sectors and globally for several decades. And we are strong believers in the asset class, small cap companies, that is. There's a number of reasons. Four that I think are particularly important are that small cap companies grow faster than large cap companies. They are often backed by founders and owners that have skin in the game, which we think is really important. They are the key beneficiaries of mergers and acquisitions. And then lastly, the market is inefficient. There are over 6,500 small cap companies outside of the US, and they're not followed by the big investment banks on Wall Street. I have some charts in the page or in the deck here that I'll show you to kind of illustrate that. As Julie mentioned, we have a talented team of first-rate investors, and we employ a time-tested philosophy and process that is really trying to identify companies that generate strong corporate performance. What is that to us? It's enduring growth of earnings and cash flow, and then the reinvestment of those cash flows back into their business at returns on capital that are in excess of the cost of capital. We think that's the key ingredient to delivering long-term investment performance for you, our clients. The investment backdrop over the last 2.5 to 3 years has been quite challenging. There are really three key drivers of that, the three I's as I call them. It's been inflation, it's been interest rates, and it's been invasion or kind of geopolitical conflict. And this environment has led to a severe repricing of international small cap companies, and in particular, the highest quality and the highest growth ones. As a result of this, the investment returns that we've delivered to you have not been good enough. We're absolutely focused on this. We believe in continuous improvement. We strive to learn from our mistakes, but we will not change our stripes in terms of how we invest. Why? Because we believe that's what we've been hired to do. We are a small cap quality growth manager, and we believe that's the best way to generate long-term value for you as clients. That being said, we think the market environment is changing kind of as we speak. Two of the three key drivers that I mentioned are improving. So inflationary pressures have eased and will continue to do so. Interest rates around the globe are normalizing and are anticipated to continue to do so. The geopolitical landscape is a bit of a wild card that remains complex, but we think this investment backdrop is transitioning, and the headwinds that we've faced over the past couple of years, the headwinds that have punished the best small cap growth companies internationally, are abating, and we expect our investment performance to improve accordingly. So let's dig in, if that's okay. What I thought I would do here, and I invite any questions and interrupt me at any point. I have been accused of talking too fast. So if I do, and if you want me to pause and repeat something or go back and explain something, please holler, or throw something at me, whatever it takes. But Julie kind of did a quick introduction to our team. What I thought I would do is I would discuss our investment philosophy and our investment process, kind of how we get to the portfolio that we manage for you, what that portfolio looks like today in terms of the characteristics, how that compares to some other asset classes and the benchmark. We've got a quick stock example in here that I think will give you some sense of the type of companies that we invest in. I'll touch on market performance at a high level. We'll dig into your investment performance, the key drivers of results over the last 2.5 to 3 years. We'll talk about how the portfolio is positioned, and then we'll wrap it up with our outlook, and we'll leave time, hopefully some time for questions. But again, please interrupt me.
So let me know what page you're on and what page you want, and I'll take care of it.
Perfect. Thank you so much. So I'm going to jump. There's a bunch of stuff in here about our team, about the product. I'm going to skip that for the sake of time. What I will tell you is that that team that Julie mentioned before, we have one team, one investment philosophy, and one process. And we think that's really important. We think that is a differentiator. There's about 60 investors on our team that all meet 4 times a week at 9:30 in the morning to discuss what's happening in the world. And we think that's a differentiator in the marketplace. I'm on page 11. So we're going to talk just about our investment philosophy. There are really 3 key pillars to this philosophy. We think, as I said, identifying the best companies in the world, the companies that generate sustainable value, again, enduring cash flow and reinvestment of that cash flow at rates of returns ahead of the cost of capital is the way to generate value for investors. The companies generate the values, the fund managers do not. We are the allocators of capital. We try to allocate to the best opportunities in the marketplace. And we think quality businesses that have demonstrated competitive advantages, they either have differentiated goods and services, we think they can generate growth in earnings and cash flow that for longer than the market anticipates. And we think that creates value for shareholders, in particular, as you go down the market cap spectrum and it becomes less efficient. There's just so many companies out there. We think having a holistic perspective is the right way to do that. So we think in order to identify those companies, to analyze the businesses and the competitive dynamics around the globe, having a global and inclusive perspective is the right way to do it. So again, our entire team meets every day. We talk about where everything's happening, where people are traveling. We view the from all corners of the globe in terms of what's happening. The last point is we believe in the art and science of investing. Because there are so many companies out there, you have to have a strong quantitative background to have a filter to help you sort through everything that's happening. We've been using quantitative tools on our team since its inception. And importantly, they're designed by fundamental practitioners. They're not just given to a bunch of people in a room that goes back and back test things. They are designed and improved upon by the fundamental analyst team. We rank all companies globally on these models. We have a number of different models. We rank them on a percentile basis from 1 to 100, and we use that to help us filter through what's happening around the world. That ranking is updated daily. And it's based in our own proprietary systems. The transparency, anybody can pull it up from any device anywhere in the world. On page 12 is a diagram of our investment process. And there are kind of 5 points on this wheel here. As I've just described, kind of organizing data you think is relatively simple, but it's actually quite possibly the most important part of this. Again, there are over 10,000 companies listed around the world. There are 8,000 small cap companies and 6,500 of them are on markets outside of the US. Again, we rank every company on a percentile basis. So the organization of that data helps us filter through a lot of noise. It helps us identify, the point 2 on this is our pool of companies that we're interested in. We call that our eligibility list. From there, our research team goes out and interviews management teams, understands the competitive dynamics in different markets. We set our priorities, we perform fundamental research. We're bottom-up fundamental investors at our core. So we meet with management teams, we talk about their competitive advantages, we test products, and we answer the same 7 questions for companies that we're researching, whether they're large cap companies in the US or micro cap companies in Indonesia. The process is the same across the board. And lastly, we manage the portfolio. We have a thesis tracker that tests the original hypothesis. We always are trying to optimize the portfolio and make sure that we are in optimizing for the highest growth and the highest quality of the right valuation. So page 13 and 14 are illustrations of how this process works and kind of the outcome of this process. On page 13, I just wanted to show effectively what that investable universe looks like. You can see on the left-hand side how much of the number of companies are in the US, are in developed markets outside of the US, and are emerging markets on the left-hand bar. And then you look at the bar to the right of that, you can see how many of those are in small cap versus non-US, large and mid, and then the US. Basically, the message is there's a lot of small cap companies out there. There's a lot of dispersion. It's a great fishing ground for investing. The middle bar here shows what our eligibility list looks like. So after we go through that filtering process, we come up with about 2,500 securities that our team that we are researching at any given time. You can see the relative breakout of that in terms of what's small cap, what's non-US, large and mid, and then what's on the US. So a very big portion of this is non-US small cap. And on the right-hand side, it's just what that looks like, what that blue bar looks like by country and by industry. So it kind of helps you visualize where our process points us in terms of investment opportunities. On page 14, what I did was we put in here what the fundamental characteristics of this process, as you think about the different places for you to invest your money and what our portfolio, what your portfolio on the far right looks like. So what we'd have here is, and again, these are some of those quantitative models that we have. I talked about how we rank companies globally on a 1 to 100 scale. We have models called the quality model, our growth model, our earnings trend model, and our valuation model. And you can see the underlying KPIs, the underlying metrics that support each one of these models. But so you can see just for US large cap, what does that look like? 19 is out of 100 is good. So high quality. Why is it high quality? Because they generate high returns on capital and they have high cash flow return on investment. Growth is about 50. So on a historical basis, US large cap has generated about 17% earnings growth. There's currently pretty strong operating momentum. That's the earnings trend, and the valuations at the bottom. So the US large caps are trading at 22 times earnings right now. As you move from left to right, you kind of see
that
what.
just
Yeah,
for that percentile for valuation for US large cap is not as attractive. The
that,
percentile is relative to.
correct. 100 would be bad, 1 would be the best. So on a relative basis, that shows you that US large cap is relatively expensive. As you move to the right, you see what non-US large, so you can think of these as your benchmark, as kind of the core benchmark for each one of these different categories. You can see what non-US large cap looks like, what US small cap, and then the 1, 2, 3, the fourth one over is what I would characterize as what the core benchmark looks like for international small cap. And you can see how that scores across all of those metrics. The last one shaded in blue is your portfolio that we manage for you. What does this portfolio look like? It's very high quality. So it's a 23 on our quality model. You can see what those returns on equity and cash flow return on invested capital looks like. So really high quality, as high quality as you get in the US, even though the opportunity set globally is not as attractive. The US companies are the best in the world. So what we've done is we've optimized our opportunity set to deliver the type of quality that you get in the US.
Excuse me. Perhaps I missed it. How do you define quality briefly?
Yeah, sure. So quality for us is returns driven. So the number here, these 3 or 4 variables here are the biggest drivers of that quality model. So it's really cash flow, return on invested capital, your return on equity, and then your debt level.
Just these 3 things?
Yeah. I mean, there's a lot more in the model, but those are the 3 most prominent ones.
All right, well, thank you.
So what you can see is your portfolio is trading at a significant premium to the small cap core benchmark, 96% and 70% higher returns metrics relative to what the core benchmark would look like. It's high growth. On a kind of realized earnings per share growth over the past 5 years has been 21%. The operating momentum of this portfolio right now is strong. So that's what this earnings trend number highlights. And this is the revisions of breadth. So the number of companies where you're seeing revisions, positive earnings revisions are coming through in small cap. And on a valuation basis, it trades at 20.5 times earnings. So it trades more expensive than the core benchmark, about a 50% premium. But again, it's cheaper than the US and it's much higher quality and much higher growth relative to the non-US and to the small cap opportunity set.
Does it generally trade above the valuation because it's a growth
Yes.
oriented?
I'll tell you, so on a historical basis, we're trading about in line with our 7-year history, but it's been a pretty wild, if you think about kind of COVID and the impacts of COVID, and I'll show you a chart or two in a minute. We're buying this portfolio today for less than half of what we had to pay for it in 2021. So it's as I said kind of up front, we've seen a pretty significant repricing of small cap assets and really the highest quality ones. The sensitivity to interest rates has been really high, and the correlation to interest rates has been really high, but the growth has continued to come through. So as we see interest rates easing, abating, kind of that pressure globally, what we think, we don't need to see multiple expansion. We don't need to see it get more expensive. What we want to see is just the earnings to come through. And again, on a historical basis, we've done 21% earnings growth. On a forward basis, it's somewhere in the 15, 16%. And again, but remember, this is an inefficient asset class. So this is based on what the consensus expects for that growth. We think it's going to exceed that.
So maybe to somewhat sum up, but so a 2-part question. So as you look at this, the way you evaluate it relative to the benchmark,
Yeah.
in the companies you invest in, they are higher quality. The companies tend to be performing better from an earnings revenue growth standpoint. but then not surprisingly have a little bit higher valuation because the companies are performing better.
Correct.
And so I guess my question is, first, is that kind of typical profile of this portfolio, what you're going for, those trade-offs?
Yep.
And then two, okay, during what types of market environments would you expect this portfolio to then outperform or then underperform the benchmark?
So it's a great question. Is it okay if I jump?
Yeah, please do.
Okay, so, so historically speaking, yes, we valuation is an output of our process. So, we focus on where quality is and where growth, and then we try to pay as little as possible in order to achieve that outcome. But valuation for international small cap, for the quality end of the spectrum, has seen severe multiple compression, kind of a derating effect. And the sensitivity of that, I have on page 24. If you could just look at page 24 for me for a second. Sorry that I'm jumping around. But what I did here is we showed this is relative performance of the strategy versus the inverse of US interest rates. So what you can see here is the US 10-year is really the cost of capital globally. So we can get into kind of what US interest rates policy means for European interest rate policy for Japanese, but the Fed does set cost of capital globally. So as US interest rates increase and increase pretty dramatically coming out of COVID, in part because all the inflation, all the spending and the inflation that drove, you saw our relative performance get hit pretty hard. As what we expect in terms of when the interest rate backdrop is less of a headwind, we expect that earnings growth to come through. And again, we find higher earnings growth relative to the benchmark, higher earnings growth in our portfolio relative to the other options in the marketplace. And that's what we think will drive long-term investment performance. Sorry, did you have a question?
I do. So I know you're here for limited time and I don't want to lose the main meat here and run out of time. So excuse me if I jump ahead into something you're going to cover.
It's okay.
But I think we all know the international markets have been hugely underperforming the US market. And if you look at relative performance, this is ridiculously, it's skewed at this point in terms of US market performing.
Yes.
Could you run us more? You said you make all the internal decisions on allocation, country allocations, whatever else.
Yeah.
So I'm primarily interested in two things. Would you say the MSCI is no index is perfect, but is that the closest index to compare you to?
The MSCI small cap core index.
Correct. What you're using in your.
Yes. I mean, we view ourselves as growth managers. If you look at again, sorry to interrupt, to kind of jump around, but on page 23, I have kind of the long-term performance of the strategy. And over the very long term, if you look at, I guess, both 10 years and 15 years, small cap growth has outperformed small cap value. On a 1, 3, and 5-year view, on an annualized view, small cap value has outperformed small cap growth. So what I did on this page, it's hard to see, I'm sorry, but if you look at the boxes at the bottom, I put what small cap growth looks like relative to small cap value. And what you can see really is the last 3.5 years, value has outperformed growth. That has never happened before in the history of this experience. So I agree with you. The US market has been the place to be. It's been highly concentrated in international markets because of the interest rate environment. Value has been the place to be. We think that's likely to change given the changing interest rate backdrop. And we think that on a forward-looking basis, we think that small cap growth will come back in terms of the relative performance.
Sure. No, sorry. The question I was trying to get to, and my question really is, if we look at a 3-year number, you've underperformed by 800 basis points or 900 basis points.
Yeah.
And we all know that the performance in the international markets has been weak. That's not the question. The question is, could you take us through, this huge underperformance? I mean, it's not a small underperformance number. It's just mega.
Yes.
So could you walk us through it in terms of what was going on and how that occurred?
Yeah, sure.
So what you just described though is value has outperformed. The more value you own, the core benchmark has value in it.
Correct.
The more growth that you looked the last 3 years, the worse you're going to do.
That's exactly right. Yeah, so that, and that's what I was trying to show on page 23. So yeah, but let's go back to page 22. So certainly, on the top part of the page, you can see your performance annualized since inception. Since inception, it's flat, which again, isn't good enough. Relative performance on the left, as you go to the left-hand side over a pick-your period, has been weak. It's been negative. And look, we can, and I believe we will do better. But what has happened, if you look in the middle of the page here, you can see the relative performance by year back to 2009. And if you kind of scan that, there's some good years.
Sorry, we're on page 21.
I'm sorry, yes,
Yeah.
page 21, I
Yeah.
apologize.
21.
Yes, 21, sorry about that. If you look at the years, you'll see, some good, some bad years. Over the past 5 years, if you look at that, we had really good performance in 2019 and during COVID in 2020. If you look at 2022, that was the worst period of relative performance in the history of the strategy. And that is what's driving, that's really the difference in those long-term, the relative performance numbers. So again, what happened in 2022 was coming out of COVID, we were in an environment where inflation was increasing aggressively, and the Fed started the most aggressive hiking cycle in its history. And on top of that, we had Russia invade Ukraine in Europe, which is a big part of the portfolio and a big overweight. So what did we got that wrong? If we go back and do that again, we would have moved quickly. We would have de-risked the portfolio faster than we did. We were trying to do it in a fashion where we were confident of all of the individual companies we were investing in, but the speed at which that repricing took place, which is what I tried to put on page 24 to show you on the left-hand side there. If you zoom in, it was really 2 quarters, the first 2 quarters of 2022. And you can see the relative performance of the strategy, which is the dark line, relative to the changing interest rate environment. So that is what has impacted long-term investment results.
So if we look at a universe of your peers in your management style, what quartile would your fund be in at this point? Yeah, I'm sure you have those numbers.
I don't have my numbers in front of me. Relative to a growth manager or relative to a core manager?
In your universe. So we're talking about if you say MSCI, let's say the small cap. So at this point, I mean, we are not comparing you to the US market. You're not comparing yourself.
No.
You're comparing it to an index.
Correct.
Right. So the index fund stocks would largely be subject to what you mentioned
Yeah.
also.
Yeah.
You have a relative underperformance, right? Which by the definition is saying that, well, with your peers and with the index of everybody going through the same thing, you underperform that.
Yeah.
So that's what I'm asking you. Why did that happen? I understand the global political, whatever, COVID, interest rates, all that, but everybody went through that.
Yeah. So I guess my answer to that would be, if we compare ourselves to a core benchmark, we would be in the bottom quartile. We've underperformed that pretty aggressively. And again, if we compared ourselves to a group of small cap growth managers, I believe you guys are invested in WCM for their large cap portfolio. WCM small cap portfolio and our portfolio performance is pretty similar. So thinking about peers that do what we do, that invest in quality growth companies, our performance has been similarly bad for the last 3 years. And the point I was trying to make is that if you look at the chart on page 23, is to show that over the long term, small cap growth outperforms small cap value. We've just gone through a very extreme period where value has outperformed. I believe that's changing. A couple of months doesn't make a change, but the change in the interest rate backdrop, we finally got an interest rate cut from the Fed last week. I believe the headwinds that have hurt this portfolio, not from an earnings perspective. So again, the companies that we found in this portfolio, there's 112 companies in the portfolio. So there's always going to be little things here and there, but by and large have delivered the earnings growth that we would have expected. Again, a 20% historical earnings growth on a 5-year basis, but they've been repriced down pretty aggressively because the cost of capital, the cost of money has been high around the globe. That feels like it's changing right now.
I just want to know, as Sharif said, you underperformed in 2022 by 15%.
Yes.
In 2020, you outperformed by 15%.
Yeah.
2019, you outperformed by 12%. But I'm just as frustrated as Sharif is with
Yeah.
2022.
Yeah.
But recognizing that
Yeah.
you'd have very fine performance in this prior couple of years.
Well, that's why I tried to show, right? So that the chart on page 23, it's, it's kind of retail-y in nature, but I wanted to just show kind of the long-term trend and to show kind of both the positive impact from, look, we did well during COVID, and then the negative impact from kind of coming out of COVID and all the distortions that came out of that. So you can't have it both ways. You can't just pick the positives and try to ignore the negatives. But if you just remove both of those, the portfolio is doing kind of what we'd expect it to do.
Let me follow up on sell discipline.
Yeah.
Given your experience in 2022, you said there's some things you would do differently.
Sure.
Could I understand more specifically what your sell discipline is?
Yes. So specifically in 2022, what we would have done differently is the portfolio was expensive coming into that. So we had come out of COVID, we had high earnings growth, but the value that the price that we were paying for the growth that we were receiving was high. So on a forward-looking basis, the portfolio was trading about 40 times earnings. So why? Because you saw explosive earnings in places that were benefiting from the fact that everyone was sitting at home. The electronics industry was booming. Any kind of digitalization, helping companies get online was exploding, and the cost of capital went to zero. Effectively, they cut interest rates to near zero, and so as a result of that, we saw an expansion in the multiples that people ascribe to the companies that we invested. So, what we got wrong was the Fed started talking about transitory inflation in the fourth quarter of 2021. They said they had it under control. Inflation was going to be transitory. They didn't need to hike interest rates. And, if I go back and say the one thing, it was kind of December of 2021, where Powell came out and said, okay, he kind of pivoted and said, we're going to have to increase interest rates. That's where we should have been bringing down our valuation risk. We should have been lowering the growth and return thresholds that we have in the portfolio and saying, well, even though that's what we do, we look for the highest quality and the highest growth. We should have been saying the environment's going to get more complicated for these companies. Let's lower those and let's go to cheaper companies. Now, again, if we didn't stick to our knitting, we would have turned into a small cap value manager. But again, that's a good way to get fired in this business. You get hired to play a role in a portfolio, and we play the quality growth role.
Sure, if you have another.
Two quick further questions. Can I assume on page 21 that the numbers reported are general performance reporting numbers? That means they are not net of all costs,
They're net of
Trading.
fees, yes.
They're
Net of fees.
but not of trading costs.
It's in a fund, so it's all encompassed in the fund. Yeah. There's
So-
no fees beyond this.
Trading costs are always included in performance.
Okay, but general performance reporting sometimes doesn't. So, and number two on page 29, if we look at country allocation,
Mhm.
would you agree that you were under allocated to some countries that performed and over allocated to some areas that underperformed? The attribution analysis, in other words, here, would that hurt you
During that period of time?
during whatever the 3-year period that we're talking about,
Yeah,
the 5
okay,
10-year period?
Sure, yeah. So I guess the way that I would characterize that is during 2022, if you see where we are today, so we're overweight Europe. Europe is 29% of the portfolio, the UK is 11. So those are kind of the two biggest overweights. During 2022, when Russia invaded Ukraine, yeah, that overweight, and that's a structural overweight. It's principally small cap industrial companies. They tend to be in the Nordics. They're great companies in Sweden. Back on a couple of pages, you can see how many companies kind of go through our process from Sweden. So that was a difficult place to be during that environment. We didn't have anything in Russia. We didn't have anything in, around Ukraine, but being in that neighborhood hurt. Since then, so I would say the biggest drag on performance on a year-to-date basis, actually over the last 12 months, has been Japan. And I put some statistics in here on Japan, but Japan has been driven by, it's been a value market for the last couple of years. The reasons are we've got a couple of things. So one, we've got the end of 30 years of deflation in Japan. So they're finally getting some inflation. You're finally seeing some real wage growth. The Bank of Japan is starting to normalize interest rates way after everybody else. They just did their first interest rate hike this summer. And what we invest in Japan is the domestic market. Small cap companies are generally domestic. They generally don't export. And the yen had a 30-year low pretty close to when we printed this book. So it hit a 30-year low at 160 on kind of June 30th or so. Today it's at 130, 143, 144. So you've seen a 10% change in the yen since the Fed cut, and the Bank of Japan has helped firm. We think that the environment for what we do in Japan is changing. It's been challenging over the last 12 months. But I was just in Japan last week, just meeting with a bunch of companies we have in the portfolio. There are some great little companies there that are really innovative, that are solving some of the challenging problems that demographics and labor shortages that they have in Japan. And we think that we're well positioned in Japan going forward. But the two countries, to answer your question specifically, the two countries where I think we have endured some pain in the last 3 years have been Europe, kind of broadly speaking, because of invasion, and Japan more recently. Now, the flip side of that is where we could, and what would have been nice to be more invested, is India. India's small cap is a phenomenal market. It is getting deeper by the day. The number of IPOs in India is hitting a record this year. India is not China, so it's benefiting from the fact that it's not China. Basically, China's 2% of our benchmark. We're kind of at benchmark weight in China. We're 10% in India. We're slightly ahead of what our benchmark is. But being invested in India over the last 2 years has been good. It would, if we could have been double, it would have been great. The challenge with India is that it's really, really expensive. And so kind of the discipline and kind of self-discipline and portfolio discipline, what did we learn from the environment that took us into the period of underperformance here is we have to be optimizing that valuation dynamic. So we can't just be going all for the highest growth and the highest quality, because doing so leads to valuation risk. And so we're trying to manage that valuation risk in India carefully, while also trying to capture the opportunity that's structural in nature in terms of the number of underpenetrated markets, markets in India is super compelling. So I hope that, I could go into additional country allocations.
Absolutely, and don't get my questions wrong. I'm all for investing in managers that are out of favor, because they're the ones who perform in the end and not the ones that are ahead. So I just want to be clear where the underperformance came from.
Yeah.
And where you are positioned at this point and what you all are thinking. So that was more the
that's great. No, look, I welcome the questions, and hopefully my answers have helped give you a sense of how we're positioned. So maybe page 29. Well,
There's country allocation, top down.
And I'm sorry, I'm taking up too much time. I think I need to stop and let you go on.
No, that's okay. I think I'm trying to make sure that we get all the points across, but I want to make sure we answer your question. Sorry.
Is country allocation a top-down function, or is it
It's a bottom function.
It's a thought of your.
It's exactly. So the process points you in the right direction. Again, that funnel that I talked about up front, and again, I tried to show, back on page, I think it's important just relative to the country discussion too. If you go back to, I'm sorry, what page that was 13 perhaps? Yeah. So this on the right-hand side is what that process, what the eligibility list includes. And so you can see kind of what that looks like by country and what that looks like by sector. If you were to overlay that with the portfolio, you'd see pretty high correlation, except for China. So China is the number one in terms of the number of companies that come through our process in China. Returns on capital are high in China. Return of capital is always a question. And so that would be the number one difference relative to that. But the process is bottom up in nature. So we go to where we find the highest quality companies with the most innovative products that have the strongest competitive advantages, and we invest there. And then the risk management, the portfolio kind of allocation decision is to say, okay, the outcome of this means we're really overweight here, or we're really underweight there. Are we comfortable with that risk? And that's left to the portfolio managers.
So it's basically bottom up.
Yes,
But then you take another cut and say, are we overweighted?
correct. Correct.
Is there anything else that is really critical to your investment process that we ought to know before we do adjourn? And I'm sorry to cut it off.
It's,
but-
it's
no, it's
totally fine.
great.
You guys have a big
But
agenda.
unfortunately, we have some other things to attend to.
Of course.
I wish we did.
Well, so we intentionally kind of put this deck together, and there's more biased. I think there's more good stuff in the deck for you to look through if you have time. But I think we hit on the process, the philosophy, the performance that we talked about, why we've underperformed, again, sensitivity to interest rates, kind of value versus growth over the last 4 years. Japan more recently, I put a couple more slides in here just to show you kind of what's happening in Japan and how we think that's changing. But look, from an outlook and from a positioning perspective, we feel that we're well positioned in the portfolio right now. So again, the characteristics of the portfolio that I showed you were that was intentional to show you the type of growth that we have in the portfolio, the quality of the portfolio, and the reason that we think that it's been held back in terms of the actual performance has been principally driven by those 3 factors that I mentioned, which I think are abating right now. So,
And from a calendar year perspective, principally driven by 2022.
principally,
Our whole portfolio was driven down
it was a
by
tough.
2000. I'm not talking just about your
Yeah.
portfolio. This entire pension plan crashed in 2022 because nothing worked.
Yeah.
So we understand that. We just want to understand
Well, so
that you're taking whatever steps to try to mitigate.
oh,
Because there's always going to be a 2022.
correct.
We just have to be able to mitigate it earlier.
I think that's exactly right. Again, if we could get a redo, that's what we would do. Look, a large portion of my net worth is invested in this strategy. We kind of eat our own cooking. I have been, for what it's worth, adding to my position in this portfolio. I think we're well positioned to recapture some of that terrible 2022 as the environment kind of gets less headwinds become more benign in nature. And we think that the way that we invest in this portfolio, finding the best companies globally, the fastest growth companies, we think that generates returns over a long period of time. What we're looking at right now is a point of time where we've just had a 3-year period of really poor performance for the asset class, and our performance was not good enough, to be clear.
As a final item, Phineas, follow up on Sharik's question. Could you work with our guests to come up with quartile ranking in a manner?
No, that's okay.
It's an arbor.
We'll have that next
We
month.
normally do that, but I want to make certain that we're using the right.
We use a non-US small cap.
The core benchmark.
Well, it's just a non-US small cap peer group. We can look at a non-US small cap growth universe, but the observations are really small. The answer to that is going to be the more growthy you are in either peer group, the worse you're going to look right now at this point in time.
Right.
Because of sensitivity to rates and value outperformance.
That's education on it. So
Just
Yeah.
finish up and then you have it in here.
when we come back to our manager deep dive, just so you know.
Rates have fallen this quarter.
Correct.
What's the quarter to date return?
Yeah, I put that in on that same page. I'm sorry, what page is that again?
21.
We're on 21.
21. It's as you'd expect. So it's interesting. I look at back on a early part of the deck, you can see all the different portfolios we run on this platform. So we have everything from global to emerging market, small cap, and everything between. The 2 best performing strategies on a quarter to date basis are small cap strategies, international small cap, emerging market small cap. So the sensitivity to interest rates, as we've seen interest rates normalize, is unfortunately, it's hard to get away from. That is the biggest driver. And we've seen the relative, so we've got strong relative performance for the quarter. Again, a couple of months doesn't, let's be careful not to extrapolate that. But it's performing as you would expect it would, and relative to the rest of the strategies that we manage on our platform.
And to put the exclamation point on it, that has continued through September as well. So this is through August, but if you look through this current month, that outperformance has continued.
Excellent. Thank you so much.
Thank you for your questions.
Thank you. Appreciate it.
Thank you guys for coming.
Safe
Yeah.
travel back.
Thank you.
Did you come in just this morning?
Last night.
Oh, you could have had the hurricane.
Yeah, it was, well, we've had 2 weeks of no rain in Chicago or through the Midwest or even longer. And it was like,
So did we.
Yeah.
Until.
I know, I needed it, so it's all good. Have a great rest of the day. Thank you.
Thank you.
Great, thanks, Benny. Appreciate it.
Sure, you were asking what the rest of us were wondering. That was time very well spent.
I'm gonna change the order here. I think we need to go to item number 6 next. And then we'll come back to item number 5. Item number 6 is ACG.
Oh, that's us, Bert. Even better. Do you want to dive into the materials notes? Do we want to take a minute, talk about, their presentation, thoughts?
Well, while it's fresh in everyone's mind, please, go ahead.
So again, William Blair, they've, been in our portfolio for 15 years, very much really a growth manager. And they're in the international small cap space, which there aren't a ton of managers in the space, as Jason was alluding to. They certainly focus on the growth side. And very much they kind of finally got to it that ultimately, a lot of their performance is driven by traditional growth factors, particularly as it relates to rates. Question I was going to ask them, we ran out of time, but their kind of thoughts on tracking error. But you looked at that year over year page of their overperformance and underperformance, and that's what tracking error is. They're big swings, plus or minus, versus the core benchmark year to year. And that's going to kind of continue to happen both to the negative and to the positive. Certainly, to be fair to them, they've been in a headwind as a growth manager the last couple of years. That's what's led to their underperformance. And that's why it's kind of screaming out. There would be periods, if we were to show probably should have brought it, their return as of the end of 21, the 135, it would have looked fantastic. They'd been top quartile. So that's kind of what we would, expect with them. From a positioning standpoint, at ACG, we still prefer overall to have, we call it that neutral approach. So in other words, not overly value, not overly growth. And now that William Blair is our sole growth manager with international small cap, we do lean to that growth side. Now,
But I mean, to be fair, you do have an index of comparison. And the whole purpose of the index to comparison, and there is tracking error of 200-300 bips is one thing, but a tracking error of 800 bips per year over 3 years is a little more than that. To be respectfully,
We were going. with-
I'm not
we had
saying
two
that,
managers.
that we should change, but I'm just saying that it is an index of comparison, and all the reasons we are stating, all the companies in the index also go through the same stuff, whether it is the war or whether it is the interest rates in terms of performance. Just to be clear,
As we
I
said.
don't want to be lost there.
We replaced
In the recap.
Sanderson with Silchester, and we reviewed the entire international portfolio. We said at that time we should replace Mondrian and move those assets into Silchester because they move a little further down in market cap. We also said at that time, our preference would be to have a single core small cap manager that's not taking, because we don't have two anymore. We don't have a value and a growth. And our preference today would still be to have a single core small cap manager for this piece of 2.5% to avoid some of the significant swings we're seeing. We don't believe William Blair's process or the thesis around them is broken. They're doing what they do, the quality growth manager. The last 3 years, that hasn't been in favor. So we do think going forward, having a single manager that's more core-like would be our preference in the portfolio.
I think there's a question that we have to answer later is, they may be the best performing manager next year. I wouldn't be surprised.
Right.
Okay. since that's so out of favor, but can we take that kind of gyration on the, and that's something that, we have to discuss in asset allocation, so.
But we take a growth manager, and we're comparing it to our core benchmark, because we don't have a value manager.
No.
to add to it.
No, the comparison is not to the core benchmark.
We
The
compared
comparison
it
in
all.
here is to an index that reflects them the closest possible.
We show both on our report. They were showing in their presentation the core benchmark. In ours, there's both. So yeah, that certainly adds to additional.
MSCI
core
small
benchmark,
cap, yep.
Greater dispersion.
So are you recommending specifically that we change? Is that-
Our recommendation,
Is that substantive or cosmetic? I mean, basically, we have small growth on one hand and small value on the other, and small value is part of Silchester. So are we changing because of cosmetics, or are we changing because we think we can upgrade in our?
we think we could upgrade the overall portfolio structure by having a single core small cap manager to complement WCM and Silchester.
Without overweighting small cap altogether because of the Silchester allocations.
Right, wouldn't be any different than where we are today. We're talking 2.5%.
From a cap perspective.
Would you bring your thoughts back at the next meeting?
Mhm.
Yep.
Just bring them back. So not say we're gonna do it, but let's say.
Right, we're not,
Oh, yeah, we didn't plan on that, but obviously important to hear from William Blair directly for this group.
Yeah, I'm looking at 1 year. Had they not been so much at variance in 2022, I don't think we'd be having much of a discussion about it. 2022 was a killer. But 2 years earlier, they had outperformed their benchmark by the same amount they underperformed in 2022.
Right.
So that,
Well, actually, the 10-year number is also over 100 bips underperformance.
Yeah. but that's, I think, driven.
it's all driven by,
It's all driven, yeah.
It does hurt.
and
But
our
that's because
comments
they're-
are really not tied to their relative performance over the last few years. It's due to portfolio construction and changes that we've made in the non-US equity.
I mean, if we look at 2020, they outperformed by 15%,
Yeah.
so that negates 2022.
That was
So
my
it,
point.
yeah, but so I'm saying it's not just 2022 because they also have 2020 where they are outperformed. It's just an average. But anyway, I think we've spent enough time here. I think we need to get to other stuff and come back.
No, I do have one question,
Yeah.
and that is their statement that the growth normally outperforms the value. And that just wasn't the case when we experienced those losses. Do you agree with that?
The growth normally outperforms value.
Mhm.
I don't think normally is the right term there to expect that happens more often than not. I think what's typical is it ultimately gets split. So their
Right.
comment when they were showing those pages of, I think it was 21, Jody, where you kind of showed if it was red at the top, that meant that
Mhm.
value would outperform growth. And it is a little bit unique. I think there were 3.5, 4-year periods of that stretch in a row. So typically it doesn't last for that extended of a period. Normally would happen, but I think, we're experiencing this. The reason they did so well in 2020 and so poorly in 2022 is because they're more growth oriented than the benchmark. And so it just goes to kind of a little bit of our comments of kind of our preference to be overall more on the core.
Over the
side.
last 15 years since you've had William Blair, that statement would be slightly true. So the small cap, the MSCI ACWI ex-US small cap growth benchmark
Mhm.
is up 6.79% over that 15-year period. The core index is up 6.65, so 14 basis points difference. So slightly true. And they're up 6.73. So
So you
they're
have
up,
to compare it to the value.
well, not, right, but if
But
the
the value would be below.
the value is going to be below the core, slightly below the core. So I'm just,
So going to Jody's question, the growth has outperformed the value.
Correct.
side.
because
That's
it's up,
over the last 15 years.
Cumulatively, it was
I mean, slightly, yes,
Going back to Jody's question.
yes,
If I understand your answer. correctly.
yes.
But you're not showing that here. Just because we're not, the small cap value benchmark and small cap growth benchmark are not reflected here.
Mhm.
Okay, fine. Can we proceed now?
We can proceed, yes.
All right, can we, let's take us through your performance report expeditiously, please.
Okay. We will move
We have to
through
get the Western,
this
and
quick.
we're not gonna talk about domestic versus international equity allocation at this meeting after all.
Okay.
Okay.
So one of the ACG staple docs that says monthly ASAP reports.
Okay.
So our performance, this is as of August 31st. Flipping to page 3, and I'll go through all of this quickly, because overall, ultimately, it has been, continues to ultimately be, especially last couple of months, really led to a very good year from a performance standpoint. We continue to see really strong returns, particularly from the equity side. Yes, in US large cap continue to perform well, but we're certainly starting to see all the other areas, US small cap, international, adding quite a bit of value there. Also seeing particularly on the interest rate side, interest rates dropping. So, this is as of August 31st, this data here. And in August, Chairman Powell of the Fed came out and talked about how likely to drop rates. Their Fed meeting in September, immediately everyone kind of thinking it'd be one cut of 25 basis points. And then there was a little bit of uncertainty. Then as we saw last week they cut for the first time since 2020, and they cut 50 basis points. So that certainly dropped rates, put a pop in bond prices. But as of August 31st, so if you look to the left-hand side of the page, these are the returns for our major indices in our portfolio. Dark blue is the month of August. The light blue is year to date. So we're 8 months through 2024. And this you can see from a blue standpoint, really everything positive except for US small caps are slightly down for the month, but actually led by international. EFA index up almost 3.5% for the month of August alone. And then you see year to date, these lighter blue columns, again, really strong performance. Yes, the S&P 500, which really, especially in the first half of the year, if you remember, really driven by this craze for AI, up 19.5%. But you can see kind of catching up, particularly with the EFA index and emerging markets, both up, emerging markets almost 10% here year to date, and the US small caps up about 10.5% there at the bottom.
Just to add to that and bring us forward through yesterday, quarter to date, small cap has outperformed large cap by over 3%.
You're talking domestic.
Domestic, Russell 2000's up 8.7% quarter to date.
Quarter to date, not year to date.
Not year to date, but that's since rates started falling. Rates are down 64 basis points.
That is typically expected.
When
When
rates
rates
start to
fall,
fall.
small caps begin to move.
Just again, because I think in 5 days, these numbers are very good. Your 1-year return of 13% on an absolute basis. At the end of September, that 1-year number we would anticipate should improve even more. Last September, on the month, every asset class was down 5%. That quarter ending 9/30 of last year was a really bad quarter. I was just looking this morning, the 10-year return on every major asset class through yesterday is up about 150 to 200 basis points above what the 10-year annualized return was at the end of September of last year. So pretty significant bump up. Bonds is the worst performing public market. Trailing 1-year basis through yesterday, bonds are up 10.7% as rates have fallen. So I think September numbers are going to look very good.
Historically, August and September are the toughest toughest months of the year for US equities. This year, it's been a little different. August was actually fairly tepid. First week or so of September was horrible, but then first week and a half, but then it began to stabilize, and it's actually been pretty good.
And it rotates. We're seeing some rotation. So not just small cap outperforming large cap, we're also seeing value outperforming growth in the US and non-US outperforming slightly.
Yeah.
And I mean, to your point about this expectation of continuing cut in rates, what's that going to do? That's make it cheaper to borrow, right? And so some of these real large cap big companies, certainly it helps their balance sheets, but they don't need capital as much as some of these smaller, more locally focused small cap companies. So that's
There's more money than the state of California.
Yeah.
Speaking of borrowing, can we go to Western Asset?
Yes.
So we mentioned that there's another staple piece, says Western Asset Management update. We mentioned this at last month's meeting, but just want to bring you more up to speed. So I met with the co-CIO, Michael Buchanan of Western in our office. Beginning of this month, it was right after your meeting on September 4th. Just to get updated on where things stood with the SEC investigation of trade allocations made by the co-CIO, Ken Leach. Western actually identified the issue internally in October of 2023. They engaged outside third-party consultant to come in and evaluate this. Not really sure how, then later on, they were notified by the SEC that they were doing an investigation. Essentially, what is being alleged is that during the day, Western has a number of different strategies, not just the Core Plus strategy that you're in. They have many different fixed income strategies. Ken Leach is the co-CIO and portfolio manager on a number of these strategies. There appeared to be some irregularities in how, at the end of the day, trades in U.S. Treasury derivatives were being allocated to different funds. It took in Western's analysis of this, their third party that came in and evaluated this has determined that at least 75% of these trades that were done were consistent with how, or not the trades, the allocations were consistent with how it should have been done. They're not saying about what the other 25%, if there's any issue with those. So as of now, on July 26th, this was announced by Franklin Templeton, who's Western's owner. On August 21st, right before your last meeting, it was announced that Ken Leach individually received a Wells notice from the SEC. A Wells notice is an indication that they're a potential enforcement action. But right now, it's centered around the individual, not the firm. So there's a lot of noise going on here. A lot of issues. In addition, so Ken Leach has been put on administrative leave. Ken is 70 years old. Our expectations, regardless of what happens, he's probably not coming back from our discussions with Michael Buchanan. So there's a lot of uncertainty here. We don't think
How will the damage, if at all?
we've really pressed them on that. They can't quantify that at this point. Don't know that there is any damage, although some of these trade allocations did involve the mutual fund. What Western and Franklin Templeton, and I got this confirmation yesterday, have said, if there is any damage as a result of this, Franklin Templeton parent company is going to make the mutual fund whole for that. Our issue is more around the noise. In addition, and we don't have this in these notes, a couple of other senior people on this team have left. John Bellows, who was a senior strategist on the team, abruptly left in May. That time, really didn't know why. May or may not have something to do with this, but it's another senior person on the team. The head of emerging market debt, which is a sleeve within the Core Plus, also resigned this year. So there's been some pretty significant turnover on the senior members of the team. You may have read that there's a number of public funds that have gotten out, really around just not wanting to have to deal with any media risk or just the nature of this. So our feeling is that it would be appropriate that with all this noise around this, it would be appropriate to look at other candidates. We don't have to make any decisions on that today, but again, this to us would be more of a priority, looking at other candidates to replace Western.
Will you be able to present some at the next meeting?
Yeah, we have some data in here on our top 3 Core Plus candidates, but we didn't think we'd have time to go through it. Absolutely, we would.
Will not, if we are not a current WAMCO holder at the time that they determine whether or not there was damage, does that impact whether or not we get any recovery out of that?
I don't think it would. I don't think you have to stay in the mutual fund to recover that.
Okay.
And
I
our,
would hope not, but
from our,
That's,
can't-
at the legal matter, matter of precedent. I
Yeah.
don't think so either, but Maggie, can you follow up on that?
sure.
Is it a legal matter? I mean, are they doing that as a good business practice? or
yeah, I
are they
think they're doing
required to do it?
good business practice.
I think it's a,
And
yeah.
there may not be any, whatever happens, I don't think it's gonna be a major, from a quantitative standpoint, we're talking about allocations to treasury derivatives, which is a small portion of the overall portfolio. We're talking basis points, potentially.
Yeah, I mean, it's probably not worth, if you had to stay in
Right,
order to
no.
get the.
You wouldn't stay in, no,
You
for
wouldn't
that.
stay in just
No,
for
right.
that.
No.
Alrighty, fine. Then we're going to, I think, skip for now and pick up perhaps next month. The fee review, but I think they attempted to answer your question in particular. And the domestic versus international allocation will take up that next month. Alrighty, yeah, I'm sorry.
I'd
you had
like to
something?
request one thing, which is
Please.
on the real assets and on the managers there, the three that we have. And I know we did one, so I probably already have that sitting at home, but if we could just have a summation or summary of exposure of which markets those three managers are in, like, you know.
That's in the quarter
corporate
report,
versus
which we'll
residential.
have, but we can provide
Some
you,
kind of report
Yeah.
on that.
it's in our standard quarter report, which we can send you.
Just a
last
little
quarter.
educational piece,
Why
you know,
don't you
through all
send
the
the one from
three,
the last quarter.
Mhm.
on all three in terms of, you know, where and what, and I know we are waiting on some, like that, I think that would be useful. If there was already one I missed, you can just send
It
that.
was in the last quarterly report.
On all
It's in
three.
every quarter report, yeah.
Okay, I can pick that up then, if it was in the last quarter report,
Okay, well, we can also
I would have that.
show a summary of total.
Send it to him anyway to make life easy for everyone.
Yeah.
All right. Now, we're going to do something a little unusual, but it's necessary based on my discussion with Maggie. I think, Maggie, now would be a good time to go into executive session.
Certainly, you can go. Did you want to do the backdrop committee report from that? No, okay, so you'd
Just
like,
in a moment.
okay, sure.
Go into
Just need a
executive
roll
session.
call, a motion and a roll call
Yeah,
vote.
but to let everybody know that after we complete our executive session, we're coming back in the open session to carry on the business, all dealing with the actuarial report and our decisions to be made, which have to be communicated to the county momentarily. Okay, so we're going to executive session. You don't need to return.
Okay.
I can see you again, Chair.
Oh, of course.
And our visitors who are, we have a problem with our visitors. May I have,
Well, that should be done in open session, a motion to go in.
that's what I'm about to do. So, may I have, I'm gonna make the motion that we go into executive session and see why in just a moment.
Second.
All in favor?
Aye.
No, it has to be a roll call vote.
That's right.
Who moved? I apologize. Who moved?
Milt moved,
No.
Jody second.
Thank you.
All right, I'll do the roll call. Good morning, everyone. This is Matt.
Yeah,
Lucas.
do the roll call.
Pepe Finn,
Yes, sir. I apologize.
So do I.
Pepe Finn,
Yes.
Paul Hamble,
Aye.
Colonel Moore.
Yep.
Sharif Mansuri, Jody Patterson,
Yes.
Anthony Watswood.
Yes.
Milton Wilkins.
Yes, however, I'm concerned about the.
We are, and it's gonna take me a moment. I just sent our IT guy an email. Updating him.
That short conversation, so I've already talked to him and explained what my understanding. He's like, well, you've covered it all, and it made sense.
We are actually a month behind our normal schedule in dealing with the administrative side, the actuarial side of the pension plan. And we're a month behind because of the county change software, as I recall, and it was difficult to get all the information to Paul so he could do the work earlier. So it is important that we communicate our final recommendations to the county momentarily because they're right in the middle of budget time. Whereas normally we're a month earlier. And it's not quite as the other item I'd like to bring up in open session here is to reconsider the decision that the board made at the last meeting to adopt a 7.0 discount rate. And I'm going to read what I've written to myself and others concerning that. Just to make certain that my thoughts are clear. The board's job is to adopt a discount rate that the plan can achieve with reasonable confidence. I feel that our discussion of a difference between a 70% probability of achievement, which is a 7% discount rate, and a 67% probability of achievement, which is a 7.25% discount rate. Although those probabilities have been calculated and will continue to be calculated in a disciplined modeling manner. But I think the difference between that implies a precision that really does not exist in reality between 70% and 67% confidence level, or 7.25 and 7.0 target return level. I think they are essentially the same and both reasonably conservative. That is 67% confidence level, 70% confidence level. Also, based upon discussion with county officials, it appears that the nominal 67% probability, i.e. 7.25% target return level, discount level, is the one that is budgetarily, if that can get a word, workable. And the 7.0% target is not budgetarily workable at this point on part of the county. Now, I just want to make certain that people do not have the impression that we're trying to juggle the books here. They are both 7.0 or 7.25, 67% probability, 70% probability. They are all very conservative. ACG's model says that a 50% probability level is 8.5%. To me, anything in the 7.5% probability is relatively conservative. Excuse me, discount rate is quite conservative and suitable for budgeting process, which is what we're engaged in right now. So I would like to make the motion that we reverse our decision on a 7.0% target rate in favor of a 7.25% target rate or discount rate, and go with that, recognizing that it's still a very conservative number, and within easily within the variability of the returns that we're going to achieve in the future. You really can't distinguish between 7.0 and 7.25. You really can't. And obviously we're going to revisit this each and every year because expectations of asset class returns are going to change each and every year. So that is the motion I want to make.
Okay, I'm seconding that motion.
Any comment? Question?
Yeah, so the vote was what, when we, at last month's meeting?
It was, you were not here. And so it was 5-1. And
So we were 5-1 in favor of lowering it at
7 point.
Okay.
But again, upon reflection, I just feel that we ought to consider something more than that.
No, just for point of clarification.
Yes.
Even if we stick with 7, make a recommendation and the county said that's not workable in the budget, they can still say, we're gonna fund it at the 7.25, even though the board's recommendation was 7. They still have that option.
Maggie?
That's correct.
I believe the current ordinance gives the authority to the council to make those decisions. However, the same thing would prevail. You know, I think you would need to give them the information.
I didn't think that was true.
You don't think it's true?
They don't, our decision is not final. We make a recommendation, the actuary then comes up with the numbers, the contribution amount. The county then chooses what they choose to contribute. So
Where-
we say, hey, you got to
What would be
contribute.
your basis where you think that it's a board decision on the?
Yeah.
I think comments I've heard from other people in the
That's
past,
not-
so I don't have something to point
Okay.
to.
That's completely
Oh.
it's, the report is just that. It says, hey, the county should contribute this back based on the actuarial valuation. The county then chooses what they decide to contribute. So
And I think Dr. Page would differ with your interpretation.
Yeah, I think it could create a cumbersome process
well, again,
of deciding what to do.
no, that creates a political problem.
Well, financial problem, as.
Let me remind everybody of their fiduciary responsibility. Our decisions,
Our fiduciary responsibility, Jerry, I think, is to come up with a reasonable,
Okay.
achievable, and conservative number. We're not saying 7.25 is not.
these are your words. These are your words that you
Yeah.
didn't want to have the appearance of juggling the books.
Right.
I would argue that the board voted what they believed to be the correct recommendation. And then a month later, we come back in the discussion, your words, not mine, are about the financial situation of St. Louis County lends itself to the appearance of juggling the books. I'm not accusing anybody of doing that. I'm not saying that's what's happening. I'm just saying, those are your words, not mine.
I understand that. And I think we've had enough discussion, not we, but I think we've had enough discussion with county staff. Consistent with the normal process of budgeting. You suggest something and you see if it works. I mean, we're going through the process of budgeting. 7.25 is budgetarily doable and 7.0 isn't. Therefore, why recommend 7.0?
I disagree with that. Paul Kreidler's not here to tell me whether.
It's similar to you might want to have.
Paul Kreidler does the budget. I'm in the middle of budget discussions with contract negotiations. Paul Kreidler's not here telling me that he can't do it. I think that these are just decisions that the county has to make. And while I'm not naive to the fact that these are difficult decisions as to how they want to allocate their money and their resources. But again, this board operates independently of that. This board's job is to do what's in the best interest of the fund and the plan. And again, those decisions then are made by other people as to whether they want to accept the recommendations or not.
And the difference between 7.25 and 7.0, which is illusory anyway, is not worth the issue.
But no, I don't disagree with that comment at all.
I mean, the comment I just made, or?
Yeah, correct, that there's statistically very different. However, what I do think about is even though it's a close number, the 7.25 actually provides more of a headwind to participants ever getting a COLA than the 7. So when I think about our responsibility to advocate both for participants and and recognizing the county as a sponsor, and if I put those on a scale, I would say I'm comfortable leaving it.
I'm sorry, could you explain why specifically that would be the case on that phone? Why was it 7?
Because I think it would encourage the county to put more money into the plan, and that the higher funding status would eventually allow us to get to an 80% level so that we could approve a COLA. And that the probability of getting to 80% increases if we use the 7%.
I understand.
But I think if Paul Kreidler was here, he'd tell you, we don't have the resources right now to put that extra money into the
But
plan.
that's not the board's.
But since we're talking about what Paul might say, that's my
I'm
opinion,
not.
what Paul would say. Well, sure.
I don't think that would influence, as a board member, I don't think that we should isolate our concerns around the county budget. I think we should have a more macro view around how do we think about
both short-term and long-term interest of both the pension participants as well as the county.
Let me,
Can I ask
Yeah,
a point of
please,
information?
go ahead.
Because I wasn't at the last meeting. Previously, it had been 7.25. What was the impetus to change it to 7? And a particular, and if this is for the upcoming year, particularly in light of what the ACG people said regarding improved performance of the portfolio, what drove the desire to lower
Well,
the discount?
originally,
Right.
at last month's meeting, Milt proposed a 7.25. And then sort of a general discussion before a vote, most of us agreed with it. And then Jerry suggested that am I right, suggested the 7.0? That's right.
No, I think it's, well,
Or a lower.
the timing could be a little different, but no, I mean,
Yeah.
we talked about it. So there
Just
was.
to update, she wasn't here.
Yeah, no, so there's a report, basically 70, and again, 70% of all public pension plans our size use a expected rate of return of 7%. So that puts us in line with what the majority of those plans that you would compare us to are doing. And then in addition to that, if you looked at, I think Tony brought this up, if you look at our 10-year return, we were at 7%. So now we're essentially saying, and I think as the discussion evolved, it was, hey, we've been in a phenomenal market over the last 10 years, and over 10 years, we have a return of 7%. So by lowering it by just a quarter of a point, that puts us in alignment with what every other pension plan is doing. And that also then mirrors the 10-year return that we've had over the last 10 years. And so that seemed reasonable. And as the discussion kind of concluded, everyone agreed to the point that we were at a vote for 5-1 in favor of doing that. And that's kind of how
And I think we also determined, weren't we able to determine on the spot though as well, that would require about an extra $3 million payment from the county? Did we
I think
have an
that's
estimate?
Paul, I think.
Paul has numbers. Paul, why don't you chime in what the dollar impact is between 7 and 7.0 and 7.25?
Yeah, I mean, so we talked at the last meeting how if we were at 7.25, the recommended contribution would be about $48.9 million. Whereas if you lowered it to 7% for the interest rate, the contribution amount would go up for 2024 to $52.3 million.
I think it's not this board's job to tell the council what they should find.
It is.
No, we make a recommendation. They can
We
vote.
make a recommendation. Yes, but it is,
They can turn down the board's recommendation.
there is essentially, we're going through budgetary discussions with them, essentially now. We've gotten input back. This is like if I were Monsanto. And I want to, before I submit a budget to Bob Shapiro, who's CEO, I said, Bob, what do you think? I mean, and so essentially we've gotten enough feedback from them, from the administration, not county council, the administration, saying that that is not going to be doable. Now, the other thing I want to be clear on, because this is terribly important, people have different views on our responsibility to manage the portfolio, to be able to provide a COLA to retirees. That is not our mission. Our mission is to be a steward and hopefully an effective investment manager of the money which is granted to or put into the plan. It's not to drive the plan just to get a COLA. We're a long way from giving a COLA. We're not even at 80%. Let alone 90%. And so COLA is not in my mind at all. To me, it's not a priority. They're just, it's more compelling to me to drive the plan just for the sake of increasing the funded ratio of the plan.
Yeah, going back.
And that's going to be 7 years before we approach
And
that.
again, for the record, I would tell you the retirees would be extremely upset to hear you say that.
I understand that.
And current employees would be upset to hear you say that. That the board, A, does not make it a priority to do that.
Well, here's
It-
what
It's
I
not
guess-
by definition, it can't be.
I don't.
We've already adopted.
No, I understand it's semantics, but the
No,
fact
I-
that
no, I
you say
understand
out
what you're
loud
saying.
saying that, hey, man, my priority is not to do that, would be upsetting to them.
But I
Well,
think
here's-
this
I mean, I'll-
conversation, though, I think is not a good use of our time, because I don't think we're supposed to be discussing COLA right now. I think we're really looking at the discount rate right now. And I want to
I
go
think that
back.
this all comes into play, because if you want me to tie that into a COLA, by changing, by leaving it at 7.25, you create a headwind, which does that. So the reality is to talk about leaving it higher, requiring a less of a contribution, meaning that the funded level does not come up as much as it could,
Mhm.
then the ripple effect would be just that. So I think it's okay to say like, hey, let's talk about what this does and how it impacts everything else in the conversation. So we're not necessarily talking about whether we're giving a COLA or not. That's a different conversation. I'm sorry.
It is.
I know you're dying to jump in.
I mean, the concern that I have, and I've seen this in the private sector, is that the current employees suffer at the expense of the retirees, because if there's not enough money in the budget and the budget has to get cut somewhere, then maybe current employees don't get a raise because we have to get the money from somewhere, or the street doesn't get paved, or whatever the issue is, that you're right, becomes a political decision, that then the retirees, I don't want to see, and I understand our obligations to the retirees, but I also feel like it's to the current employees who will become retirees.
I'm going to be one.
I know.
Yeah,
and
I have probably
don't-
more of a vested interest in this.
I don't want to see the current employees that
Yeah.
they're sacrificed on the backs of the retirees.
I don't
Because
think,
we
that's-
want to
I
give
just, I don't disagree one
retirees.
bit. I just say that I don't think this board has jurisdiction over that. I think the council does. That's all I'm saying. So I don't disagree with one word. I just don't feel like it's our job to opine on that. Let the council, that's their job.
I agree with you on that as well, Pepe. We have a $40 million deficit, and I would challenge Barry's assertion that current employees would be upset
Mhm.
if we weren't kicking in an extra 3 million. I think that we're already having trouble
Yeah.
paying our current employees
Yeah.
competitive salaries, and this isn't going to help it.
It's just, it's not our job.
And those more competitive salaries actually do
I
increase.
hear what you're saying, but
subsequent
like I said, I
retirement dates.
think it's more, where you say macro, I
Mhm.
say nuance.
You know, but I want to go back to your question, because I had voted for the 7.0. And what did it for me is we were given percentages of confidence, basically likelihood that we would be able to achieve these percentages in the long term, not in the next year, in the long term. And we had a higher percentage of 70% for the 7% versus a lower confidence for the 7.25. But really, in the scheme of, it doesn't make the confidence is, because I'm a very conservative person. So I was going with the higher confidence, you know, but I think based on what Milt's saying, and I agree, it doesn't make that much difference. But I can be very confident I'm filling my fiduciary responsibility to the current retirees and future retirees, that either of these percentages will work, that we're okay with either one. And so I'm very comfortable, I'm more comfortable now with a month to think about it with the 7.25 compared to the 7 versus where I was thinking a month ago. And I just wanted to answer from my own standpoint, your question about how we voted it in before.
No, I appreciate that.
Anyone else have anything to say before we call for a vote?
So I mean, I appreciate what everybody's saying, and I think everybody's correct, if I can just add that in a certain way, but we're talking about $4 million, which on a $1 billion plan, 10%. If you're talking about what, 10% would be, I'm sorry, 1% would be a 10 million. You're talking about 0.5%. Okay, just to put it in perspective. What I, and we were having this conversation when before the meeting started, I had asked for the costs on the plan, and we're running at 65 bps or so. And I think this I'm going to keep this very short because I don't want to get lost there. And I know what the topic is a little different, but $4 million in perspective is small compared to the underperformance on several of the funds here. I think one of the best performing funds is our passive fund, Rumbeline, at this point. So, I mean, that should raise some eyebrows here. I'm not saying anything, I'm not implying anything at this point. I want to be clear, except for the fact that I think we need to be more proactive. I'd like to be more proactive in looking at the costs and the funds and the asset allocation. I think all three things. And I think Milton and I have talked about this, that I think we need to have a more immediate than a more deferred approach to this. So in summary, that 4 million on $1 billion plan, I think we should, everybody's correct. You're correct in terms of benefit, but I think we need to be doing a better job in terms of driving. So if we defer this, if that kind of satisfies everybody, but not ignore it, and make a more concerted effort to say that, listen, there's some areas here we need to address immediately, rather than on a 6-month basis. I think that may be a way to approach this. That may be a compromise. So, you know, go stay with the 7.25, but then we have to dive into some stuff to make some changes. That's what I'm thinking at this point. So,
Which to some extent, I agree. I mean, ultimately, the return is going to have a bigger impact
Yes.
than the percentage of the contribution, because I don't know that we'll ever contribute our way to 100%.
correct.
We have, I mean, the performance of the pension is a contributing factor to what we get to. And you can see that in looking at the years where it was over, where it was significant, funded at a significantly higher percentage.
Yeah. As a current, one last comment, as a current employee, the pension used to have no contribution required from employees. I was hired in after that was changed, where a percentage is taken out of my paycheck. So in addition to likelihoods of payroll increases and the amount of the increases, you know, for current employees, it's, if we don't have enough money in the budget, we're the ones that are gonna get hurt. I guess that's, I'm representing here all the employees, not just me. We do face right now what's good for the whole county. We have a very significant issue with recruiting talent and then retaining that talent. And if we cannot provide an attractive retirement plan and an attractive salary, we're going to continue down that path. And so right now, I think this is a very high priority for the county to be able to recruit and retain talent. By increasing the county's contribution, that's taking money away from the salaries. It's also hurting that they may actually look at changing the pension again to a higher contribution or increasing the number of years you have to be in order to save money that way. You know, so not just current salary. And so I do view it to be in the current employee's best interest to take those budgetary constraints into consideration.
Please keep in mind, 67% confidence level. Although one can question, how can we be confident about anything over a 20-year period of time? But at least there's a model there. 67% confidence level is extremely conservative. And it's totally suitable for budgetary purposes in my mind. So if there's anything else, I'd like to call for a vote. All those in favor of,
Do you need roll call?
Where you need a, no, not an open session, but
Milt made
what's,
a motion that it go from 7.25 or from 7.0.
I'm just trying to understand the
we
motion.
return to 7.25%.
We
Rather than-
change or
rather-
reverse our recommendation.
Reverse the recommendation from previously 7.25 to 7.0. We are reconsidering it and Motion is to return to the 7.25%.
Jody seconded.
Jody second. Now, well, we don't need, just raise your hand, please, 7.25. Now, the key thing is make, focus all of our attention on making big money. Because that solves a lot of.
I would argue that's been our intention for the last 7 years since I've been on the board. I didn't know that we had an intention of not making big money.
No, we've always have. But that's where I want to really focus our attention on.
So 5-2 vote.
It is
Five.
4-2.
5-2.
Oh, goodness. Oh, Paul, sorry. Not on purpose.
4-1. You abstained.
If Matt is on, still with us.
He is.
Matt, did you want to say anything further about the drop program and then we can adjourn?
Thank you. The only update is that we have a committee meeting next week, Wednesday, October 2nd in the afternoon, in which we are going to formalize our recommendation to the board. That's it.
All right. In which case, if we have to open this to visitors. Are there any visitors who'd like to make any comments? Apparently, we don't have any.
Marion is on. Marion, do you have any comments you want to make? Marion, you're unmuted. Did you want to make any comments?
No.
Okay, thank you, Mary.
Colin, user 3, 1 moment. Colin, user 3, is that Joyce?
Okay,
Okay.
is that it?
So,
That's all?
yes, sir.
All right, may I have a motion to adjourn?
So moved.
Second. Sure.
All those in favor?
And sure.
Aye.
Aye. Coming back to my point,
Wait,
We're done.
we're done. Meeting's over.
okay, well, but we can't have a meeting, we can't,
I'm not having a meeting.
no, but if you have a quorum, you're having a meeting.
I'm late.
That's.
Meeting is hereby adjourned.
Oh, wait.
Understand that. If you,
He and I are having a private conversation.